If crude oil suddenly spikes to $200 a barrel, the entire global economy will face a shock not seen since the 1970s oil crisis. Hello everyone, this is Eric from Market Meridian Finance. Every part of the financial market will feel pain. But today, we answer the most important question for investors: which one collapses first, stocks, banking, or housing? I'll show you the exact timeline, the logic, and which assets you must avoid. Why $200 oil is not just an energy problem. Let's start with the basics. Oil is the lifeblood of the global economy. It impacts transportation and manufacturing, agriculture, shipping, consumer goods. Inflation itself at $200 per barrel. Inflation will skyrocket back to double digits. Central banks will be forced to raise interest rates again, not cut. The cost of doing business will jump overnight. Consumer spending will collapse. This is not a minor disruption, this is a systemic shock. Now let's break down each sector. The first to collapse, stock market. Stocks will crash first, within 1 to 3 months. 3 brutal reasons. 1. Interest rates will spike instantly. High oil equals high inflation. The Fed, ECB, and other central banks will have no choice but to hike rates aggressively. Higher rates equals lower stock valuations, especially for tech stocks, growth companies, unprofitable firms, high dividend sectors too. Corporate earnings will collapse. Every industry dependent on energy will see margins destroyed. Airlines, logistics, retail to chemicals, autos. Manufacturing profit warnings will flood the market. 3. Panic selling and liquidity crunch. Institutions, hedge funds, and ETFs will sell first. Passive investors will follow. We will see a flash crash, margin calls, and forced liquidation. Stocks are the most liquid, so they are sold first. Conclusion: stocks are the first domino. Which one is the second to fall? Banking system. Banks will collapse next, within 3 to 6 months. Here's why. 1. Bond portfolios will crash. Banks own trillions in government bonds and mortgage-backed securities. When rates rise, bond prices plummet. Unrealized losses will explode, just like in the 2023 regional banking crisis, but much worse. 2. Loan defaults will surge. Businesses can't repay loans. Consumers miss credit card and loan payments. Energy-intensive companies go bankrupt. Non-performing loans will jump. 3. Liquidity crisis and bank runs. Depositors will withdraw money. Interbank lending will freeze. Banks will stop lending. Credit crunch equals economic paralysis. Banks don't crash as fast as stocks, but they crash deeper. Last to collapse, housing market. Housing will be the last to break, taking 6 to 18 months. Why the delay? 1. Mortgages are slow to adjust. Most mortgages are fixed rate. Higher rates don't immediately destroy homeowners. 2. Housing is illiquid. People don't sell their homes in a week. It takes months to list, negotiate, and close. 3. It needs a second trigger. Housing only crashes when unemployment rises sharply. The economy enters deep recession. Families can't afford monthly payments. Oil alone won't crash housing immediately, but high rates plus recession plus unemployment will. Housing is the slowest, but most painful bubble to burst. Now I am here to give you a full collapse timeline. Let's summarize the chain reaction. 1 to 3 months time. Stock market crashes 20 to 40%. 3 to 6 months. Banking crisis, bank failures, credit freeze. 6 to 18 months. Housing market collapses. Prices drop sharply. The order is clear: stocks, banks, housing. If you want to protect your portfolio in this scenario, you need to watch the next video on our channel. Which assets survive when oil hits $200? Subscribe, hit the bell, and comment below. Do you think oil will reach $200 in 2026? This is Market Meridian. See you in the next video.